In this video, we discuss the design and performance of a highly profitable MACD algorithmic strategy, of which the results are shown on this graph, with the black line being the Nasdaq-100 and the blue line the cumulative return of this strategy. And it's a strategy that exploits long-term alpha signals, where you can see here the median holding period is about half a year, and delivers really a high profitable risk-reward performance, where we have a profit factor of 17.6 for the Nasdaq. So we have identified three key objectives for our investment strategy. First, we want to maximize the use of long-term alpha signals. So this means we want to pre-process the data such that we can increase the signal-to-noise ratio and we can easily identify long-term trends. Second, we want to optimize the risk-reward ratio. So this means that we want to minimize risk and maximize the reward. So we want to go for preferably as high as possible profit factors. And then finally, we want to test this strategy and make sure it is robust over many years, preferably over several decades. Next, we outline the risk framework associated with our investment strategy, or in other words, the constraints. But first, we want to have a rule-based strategy, so a systematic approach. Second, we do not want any leverage in our trading positions. Third, we are only going to go for long-only positions, so no short selling. And finally, we want a low turnover strategy because this is going to minimize investment costs, trading fees, and market impact. Quick disclaimers. We do not give investment or financial advice. We are only sharing our personal opinions. So here is the flowchart or architectural design of our investment strategy. We start with daily close prices of our asset. These prices get filtered through a Butterworth frequency domain filter. And here the user can adjust the cutoff period. Subsequently, this filtered signal is being processed, and here we derive the MACD signals of this filtered price. And then we use this filtered price plus the original unfiltered price plus some additional signals that we will show in a algorithmic trading framework that also has some additional parameters that you can adjust. And the result of all of this is a highly profitable trading strategy. We share now the conceptual blueprint of our Moving Average Convergence Divergence, or MACD, algorithmic trading strategy, which is designed specifically for long-only positions. So it has three, let's say, steps: a pre-processing step, the basic settings of the algorithm, and then finally the constraints. And we identify the long entry logic and the long exit logic. So let's start with the most simple one, in this case, the long exit. It means that we will close the trade once the unfiltered price goes below a specific SMA. So it's quite simple. For opening a trade, for the long entry, we will use a filtered version of the asset price, so using a causal frequency domain filter. And then we will look, using that filtered price, we will derive the MACD histograms of that filtered price. And once we see the histograms crossing the zero line from below, so it has to be the previous data point has to be negative and the most current data point is positive, then we have a potential entry signal that will get validated only if these constraints are met. So the unfiltered price has to be above a specific SMA, and the VIX, the volatility index, has to be below a certain threshold. We give here the parameter values that were selected for our MACD algorithmic trading strategy applied to the Nasdaq-100 over a period spanning 27.5 years, starting from January 98 until May 25. So we have 4 parameters, and only the first one was optimized, and we have settled eventually for a 120 days cutoff period for the filter. Parameters 2 and 3 are the SMA period, and for that we have chosen a standard SMA 200. And parameter 4 is the VIX threshold, and here we have set let's say, a reasonable limit of 25, where we want to make sure that the general market is not within a highly volatile, let's say, conditions, because generally high volatility is correlated with lower returns. Now, as always, our trading ideas and investment edge and investment intuition are derived from the visual insights of our quantitative investing dashboard. And these insights are subsequently translated into trading algorithms that exploit long-term alpha signals and allow us to generate highly profitable trading and investment strategies. Now let's move back to our quantitative investing dashboard to illustrate our algorithm. So for today, we will select a page within the module Market Signals, Trading Indicators, and Charting Tools. Then we will select the Filtering and Classical Indicators toolbox, and within that toolbox, we'll select the MACD with Butterworth Filter page. Next, we'll select the asset. So we set the Nasdaq-100, and we'll take starting from 2023 January until 2025 May. And indeed, we want to visualize the SMA 200. So it's shown on the top graph in white. The green is the filtered price using the Butterworth filter, where we have selected here a cutoff period of 120 days, but you can adjust that if you want. And then we have the unfiltered price in light blue. The bottom graph shows the MACD signals, so the blue and red line, which are the EMA lines, and then in gray, the histograms. Now, let's focus on only the signals that are of interest to us. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. So this means in the top graph, we will only keep the unfiltered price and the SMA in white. So if you click here on the label, the green one, it removes from the chart. And for the bottom graph, we will only keep the histogram. So we will click on the blue label and red to just remove them from the chart. Next, we will look now for potential entry positions. So our long-only algorithm said that we want to see the histograms, the MACD histograms, crossing the zero line from below. So this could be a potential entry around, let's zoom in. This was on the 17th of January 2023. How was the price back then? So this is way below the 200 SMA, so this does not qualify as an entry. Because remember, we had the constraints with the 200 SMA. The unfiltered price had to be above the 200 SMA, and also the VIX had to be below 25. The next potential entry is here. So let's zoom in. So that's around the 27th of December 2023. And indeed, we see here that let's zoom back, that around December 2023, in any ways, we were above the 200 SMA. And also the VIX happened to be around 12, 13 during that time period. So we have a valid entry trade here. And if we zoom in on the we will get approximately a 16,900 value for the Nasdaq. So that's the entry level of the Nasdaq for that trade. And then we said the exit was quite simple. We said once the price crosses the 100 SMA, so this brings us to the 6th of March 2025. So, and here we have the Nasdaq around 20,000. So that's approximately almost 20% increase for that trade. So a gain of 20% on position entry in approximately, let's say, a year and a quarter. Obviously, if you would like, you could also test your own ideas and here change the cutoff period of the frequency filter. We could make it 300, so way higher. And this might give you, other ideas about trading. You can change the starting date. Let's put it to 2019, and that you might then have a look at the histograms and perhaps decide on some other entry and exit rules for the logic of your own algorithm. Now, before presenting the algorithmic trading performance, let's first review and quickly discuss the various assumptions and limitations that we have embedded in this algorithm. First, from a market microstructure perspective, there are no trading fees accounted for, no bid-ask spread impact, and no market impact in the results that we will show. Also, from a capital and financing point of view, as we mentioned earlier, there is no leverage and also no interest rate financing. Finally, from a profit and risk management perspective, we do not include any take profit limits or stop loss limits. So here are the results when applied to the Nasdaq-100 from January 98 until May 25. And so this is for our MACD with long-only positions. So what do we see in this graph? We have on the x-axis, we have time in years, and on the y-axis, the gains and losses as percentage of position entry. So when you see a green bar, it means the trade was successful. It's a winning trade. And when you see a red bar, it's a losing trade. And then the height of the bar indicates in percentage how much did we gain or lose of the entry position. So remember, we just buy and hold the index, and then when we close the trade, then we compare the price of the index when we at close time compared to the entry point. So you see very asymmetric payoffs already. You see the height of the green bars are way higher than the height of the red bars. We have some trades that that was closed at the end of 2015 with approximately a 55% gain, and we can say that we have at least 5 of them in the range or above 20% gain. And then the max loss was 6.8%, and it happened at the end of 2001 during the dot-com bubble bear market. So in total, only 20 trades over a period of 27 and a half years, with a win ratio of 65%, a huge profit factor of 17.6. So yeah, very promising results from this algorithm. Here we show some additional metrics of this algorithm, still for the Nasdaq-100 for the same time period. So the median holding period per trade is half a year, and then the median gain per trade is 8.3%. And the graph here on the right shows on the x-axis time in years, and then the y-axis, the left y-axis is the Nasdaq-100 daily close price, and that's the graph line in black. And the right y-axis shows the cumulative return of our trading algorithm, and that's the blue line. What we also see when we compare the black line to the blue line is that this algorithm will only enter the markets when the statistical edge is strong. And we see indeed that during bear market conditions, be it during the early 2000s or in 2022, or when the volatility is very high, like in 2007, 2008, or during the pandemic crisis, we do not see any losses or any entry in the market. So this is an algorithm that has shown to be quite robust and only will enter the market when the odds are very high for a bull market condition. Now remember, this was our algorithm, and the only optimization we have done was on this parameter, the cutoff period for the frequency domain filter. So the results that we have just shown for the Nasdaq-100 are actually in-sample optimization, in-sample results. And now what we would like to do is to show you this exact algorithm applied to another asset and see how that will do. So here are the results for the same algorithm. We have applied it to NVIDIA between the period of starting January 2000 until May 2025. And the graph shows here the results of the trades. So we have in total fewer trades. We only have 15 trades during this 25.5 period of time, with a win ratio close to 50%. It's 47%. Again, very, very asymmetric payoffs. And we have some trades. We have one in almost 600% gain on entry position. Another one that was closed in 2025 with almost 200%. And the worst trade loss was 14%. And as we just mentioned, we have a huge profit factor of 86. So astonishing results, but obviously the Nasdaq and NVIDIA are quite correlated to some extent. So yet this is quite interesting to see already. Here is the same view but zoomed in. So the y-axis now only goes to 200%. So just to give you a better overview of the other winning trades and losing trades. So we had indeed like 3 trades that were really high. In 2006, we had a 50% return. 2018, the 600%, and then 2025, the almost 200%. And here we see the losing trades. One in 2021 here. They are quite sparse. 3 of them happened during the early 2000 period. And this next graph shows now, again, on the left y-axis, NVIDIA price, on the right y-axis, the cumulative result of the trading algorithm. And here we see also, again, long-term alpha with a median holding period per trade of 5.5 months and a median gain per trade of 19%. Next, this table allows to compare the performance results for both assets, so the Nasdaq-100 and NVIDIA. For the Nasdaq, we had 20 trades, for NVIDIA 15. The win ratio for the Nasdaq 65%, 47% for NVIDIA. The max loss streak, or the number of consecutive losing trades for both, was 3. And then the worst trade loss for the Nasdaq, only 6.8%, for NVIDIA a bit substantially higher, 14%. And then both had very high profit factors, 17.6 for Nasdaq and 86, a huge 86 for NVIDIA. And this is the holding period. So when we add all the times that we had a position on, how much time did we spend in the market? For Nasdaq, it was 12.7 years. And then for NVIDIA, 9.5 years. For Nasdaq, the total backtest ranged a period of 27.5 years, and for NVIDIA, 25.5 years. So as you can see here, the number of trades is low, is really low, on average 0.7 trade per year. And this really means that we have a very low turnover, and so very low cost and low trading fees, and a very cost-effective investment strategy. So going back to this metric, the holding period, for both, we see that basically we are in the market between 37% and 45% of the time. So this leaves us with quite some time where capital is not allocated. And this also means that this algorithm will only trigger when the statistical edge is high, meaning that when it does not trigger, most likely the equities market, or in this case the Nasdaq and NVIDIA, most likely they are either in a bear market or a sideways market or a slight with a slight uptrend, but there is no strong, let's say, bull market. So it means that during those times where we could complement our algorithm with another allocation in, for instance, something that is very safe, like US Treasury bills, and these have been traditionally high quality and very liquid instruments, and they have historically yielded between 0 and 5%, depending on macroeconomic conditions. Now, coming back to the beginning of our video, remember we talked about our requirements for our algorithm, where we identify two main items, the key objectives and the risk framework. So the key objectives, we had three items: a strong risk-reward ratio, where for the Nasdaq-100 we delivered a profit factor of 17.6. We also wanted long-term alpha signals. In this case, the median holding period per trade is 6 months. And we also wanted the algorithm to be robust across decades, and it has been tested from January 98 until May 2025. So the first three objectives have been validated and met. The next one concerned the constraints and the risk framework. So we said we wanted low turnover. We only have 20 trades in 27 years. And we also wanted a rule-based system, a systematic system. We wanted to have only long positions with no leverage. And this has been embedded in the algorithmic logic, with both no short trades by design and also 100% cash-based allocation in the trades. So all in all, we can see that the requirements have been met. And also if we draw the same these same charts for NVIDIA, we'll see similar results. Essentially, the visuals of our quantitative investing dashboard have allowed us to create and design a long-term and rule-based strategy that mimics buy and hold. And on top of that, it really allows us to only enter the markets when the odds favor big gains and limited losses. So indeed, when the statistical edge is very strong, that's when this algorithm will trigger. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Finally, let's investigate now what would happen to the algorithm performance if we were to remove the initial pre-processing step, so without any price pre-filtering. Then this is our algorithm. We will only keep the basic setting and the constraints with these parameters that you have already seen before, and we will apply it to the Nasdaq-100 for the same time period between January 98 and May 2025. So this is the MACD performance applied to the Nasdaq-100. And in this case, we see that we have now 25 trades instead of 20, and the win ratio drops to 44%. Also, the profit factor has dropped, it's still very high, 11.8, and the worst trade loss has doubled approximately, is now 12.1%. And the graph shows you again also very nice asymmetric payoffs. So it still looks great, but the performance has dropped compared to when we did use some pre-filtering. Now, this table allows us to better compare the performance results for the Nasdaq-100 across several decades when we exclude price pre-filtering versus including it in the algorithm. And we see that when we exclude it, the number of losing trades doubles. The max loss streak also increases from 3 to 5. The worst trade loss almost doubles as well. The profit factor is still very high when we exclude price pre-filtering, but it is substantially lower than what it was with the price filtering. And also we see that the holding period substantially increases by almost a third to 16.2 years from 12.7. So this means that it also reduces the amount of other opportunities because capital is held much longer. So this, all in all, also says that price pre-filtering is really essential to allow us to detect and exploit long-term alpha. Now, in the next videos, we will dive in the wavelets filter pages where we will apply this non-causal filter to RSI, Bollinger Bands, MACD, etc. And we'll see how we can best use this filtering technique. Thank you for watching, and until next time.